can the market go down 7% in one day on no news? It's one of those things that it's inevitable. You now have this huge elephant that's in the room, and people are saying that the elephant won't break through the door. After a certain amount of time, the elephant's going to break through the door, right? Because it physically can break through the door.
It is the morning of Friday, June 23rd, and I am joined by volatility expert and tail risk hedger, Kris Sidial of the Ambrus Group. Kris, welcome back to Forward Guidance. How have you been?
I've been good, man. Thank you so much for having me. I know we're going to have fun on this one.
Yeah, we really are. So the VIX, measure of volatility, implied volatility for the U.S. stock market, is at over a 3-year low. It's at 13, super low. I believe the lowest it was since January or February of 2020. So as someone who invests in volatility, long and short, as a tail risk manager, what's that been like? And also, why has volatility been so low as we've had so much uncertainty in the market?
Yeah, so for what we do, I'll give the viewers a little overview. I'm actually a tail risk manager at Ambrus, and effectively we look to provide tail risk protection for investors. So when the market tanks, we look to have this really large return. If the market is, let's say, going up or flat, our goal is to be flat for our investors, right? So effectively, if it could turn into this sort of cleaner version of a hedge where you don't bleed on out, but you have this like a ton of convexity to have this larger return in the case of a crash. So when you think of this environment where volatility is really low, believe it or not, for us, this is something that becomes really appealing because we are able to buy derivatives or these tail risk options at a significant discount. So, what you would generally have to pay at a higher vol, you're getting for, I would say, a quarter of the price, which is good for our case. In the case of the VIX, right, when you think about, all right, why has volatility been so low? It's important to understand behaviorally what transpired, right? So in 2020, a lot of tail risk funds did really well. And then you saw a lot of tail risk strategies that were more passive. I'm not going to bucket them in the same bucket as us because we're definitely not a passive tail risk strategy, but you saw these sort of passive tail risk strategies do very bad in 2022 and this past year as the market grinded down slowly and then there was no large volatility pop, right? So that's the first important thing. From a behavioral standpoint, a lot of people were actually trying to buy volatility, anticipating, all right, it's going to be the same thing as 2020. And when it didn't come to fruition, what you're seeing now is this sort of capitulation of the hedges, right? So this year, people are just like, enough. I'm getting off my hedges. I've bled too much money. I've lost too much money on those hedges. And this is why implied vols are coming in. The other reason is really because when you look at the moves in the broad market, right, it's important to understand that implied volatility is the forward forecast of what realized volatility is. So what that means is that when you think of the VIX, just back of the envelope calculation, a 16 VIX would imply about a 1% daily move on the S&P, right? So if you have the VIX at 16 and let's say the market's saying, okay, we believe the market's going to move 1% and it's only moving, down 20 basis points, up 30 basis points, down 20 basis points, you're technically still under what the implied volatility is saying. So that's the price action we've witnessed over the last 2 months. Like over the last 2 months, we've seen the market just down 20 basis points, up 30 basis points, right? And then rally more to the upside. And when you have that, it's hard for people to hold on to these type of options and this type of volatility. So really what you're getting is this multifaceted sort of I'd say factor in the volatility landscape where people are tired of their hedges. The actual realized move in the S&P has slowed down. And the final thing I would say is that the dispersion trade has become extremely popular, right? So when you think about, everybody talks about market breadth. Market breadth is really poor. That works really well for dispersion strategies. And in 2022, that worked really well. So what ends up happening is, the vanilla dispersion trade is people will sell index volatility, right? So they'll sell like S&P volatility and then buy the volatility in the constituencies. So what this leads is this sort of excess suppression on vol. So you have vol getting hammered from all different approaches, from a behavioral standpoint, from just not realizing, and then now people kind of porting into more short volatility type of flavor trades.
So if March 2020 was a chaotic liquidation of monumental proportions, last year's sell-off, S&P down a little over 20%, it was orderly. It was not chaotic at all. It was orderly. It was drip, drip, drip.
Yeah, totally right, and that's exactly what we saw as well. There was never really that sort of panic that hit the market as well. And you noticed that when were looking at flow intraday, there was never really a situation where there was some sort of aggressive market participant that was just trying to get out of stuff. And if you remember that time during March of 2020, that was the environment, right? It was like you would wake up and the market would be down 4%. Right. And right at the open, you may go limit down or something like that. So two completely different environments. And it plays onto why we're seeing the move in volatility today.
Right. And that's a really important point you made, that it's not as if the reason the VIX is at 13 is because there's so much uncertainty and the market's moving around, but people who own options are just sort of complacent. It's that the market is moving it's not really moving that much at all. So if implied volatility, and I guess it's floating strike, whatever, for the VIX is at 13, what is the S&P 500 realizing in terms of realized volatility? And realized volatility is what actually happens. How much did it move over the past 30 days? Implied is what will it be in the future and what the market thinks it will be.
Yeah, totally. So I think S&P 1 month realized vol is roughly about like 9 or 10. I'd say like last week it was like low double digits, but it may actually be in high single digits now. But I would say, the way how the calc works is it's a rolling 1 month type of thing. And when you think of the recent price action is more in line with the realized volatility that we noticed in 2017, which is, very, very suppressed volatility where you were getting S&P realized vol at like 4, right? And this is when you had a couple of instances where VIX dropped into the single digits. And a lot of people are not even can't even fathom VIX in the single digits when you think of it, but that's how low the implied volatility in 2017 was. So effectively, what I'm saying is that the price action that we've witnessed really over the last month and a half is more so in line with what you saw during 2017. And I mean, right now you're going into the summertime, liquidity is, maybe drying up a little bit. Summertime trading may present itself and people, you may just get the market just up and down 10, 20 basis points. But if that continues, implied volatility is going to continue to get destroyed with it as well.
Right. And so realized volatility has a huge impact on implied volatility, especially if the market crashes, down 2% on Monday, down 2% on Tuesday, down 4% on Wednesday. The VIX is going to go up, and it's going to go up really quickly as people bid for protection. But then there's also and that's by the way, that the opposite of that has been happening. The market's been grinding higher, and volatility has just really been compressed and continue to compress. Do you have any sort of, not a macro view, but just a view on what volatility is going to do? Like, last summer I spoke to Noel Smith, veteran of the Chicago volatility trading, and everyone was bared up, but he said, actually, the way it's looking in the market structure, I actually think that volatility will continue to go down. And that ended up to be right. So is it, you mentioned that the VIX could continue to be suppressed and we could go to a VIX of a single digits. Is that your base case, or what's kind of your view on that?
Yeah, I think, so I did this this interview on CNBC, I feel like maybe like 2 months ago, and I got a lot of pushback because I was saying that, hey, VIX could drop a whole lot lower when VIX was around like 16. And during that time, we were just coming off the whole like banking crisis thing, and there was the debt ceiling talk. So a lot of people are like, all right, this doesn't really make sense. But really, that was the view, was that, okay, if the market continues to move this way and people are tired of the hedges, you will get that sort of like vol puking that ends up taking place. It's like a behavioral thing, right? In 2020, those type of tail sort of long skew trades did really, really well. Then you fast forward, everybody's trying to fight the last battle, and they end up taking the wrong trade. And then now it's sort of like the same thing. I feel like behaviorally we're coming back into this environment now where people are more likely to be selling volatility. Remember the feeling during 2021 when people spoke about selling volatility, right? It was almost like you were insane to sell volatility, and that ended up being one of the best times to actually go about and sell volatility. Behaviorally, we're going back into that where people are saying things like the VIX will never get over 50, right? The VIX is broken, and everybody's selling volatility. So like if volatility goes up, the Fed is going to come in and step in. So behaviorally, it feels like this is one of those time periods could go on for a longer period of time than people anticipate. However, if you do get that real sort of vol event that presents itself, it probably won't be reflective of a 2022 scenario. It may be more reflective of the 2020 scenario. So it's like more behavioral sort of dynamics that take place, especially because a lot more people are I guess in the view that like volatility does not have that spikeability anymore. The one thing that I would say, what I thought was really interesting. So we monitor the amount of net notional vega that's traded, right? And what that means is the net amount of volatility for users when they this is how they should kind of think about it.
Amount of implied volatility, how much exposure people have to, how much money they make or lose on a basis of how much options go up or down based on implied volatility.
Correct, right? So when you look at this environment today, the net notional vega short is significantly higher than it was during January of 2020. And it's not only us. I think Morgan Stanley actually had a chart on this as well that was very much in line with what we were saying. And it's interesting because what that means is that when you think of, all right, January 2020 was a time period where volatility was really low, right? Everybody was making fun of people saying, after the COVID crash, people were short variance swaps and all these people were short vol. Well, today that number is higher, right? That net notional number is higher. And a byproduct of that is all the new options that are out there, right? That can be traded, all the people that are trading these different type of products. More people have mandates that they're allowed to trade options, whereas prior to 2020, you didn't have these 40 Act funds that were able to trade options. So now it becomes really interesting because you say to yourself, well, if back then, and I'm just giving a number, a scaling, right? If let's say $500 worth of Vega was short, today you have $1,000 worth of Vega that's short, right? And that's just a hypothetical. You could see.
Is the ratio double or is it close to there?
No.
Yeah.
It's not double. It's not. I was just giving a hypothetical there, right? But I'm just saying that when you think about things in those terms, you could see how another event that takes place that could be, that could present some sort of systemic risk. You could see how volatility could go significantly higher than what people anticipate.
That makes sense. So, I mean, people are shorting volatility, and that has become a somewhat popular trade. And long volatility, people who have been long vol have just suffered. I mean, if you just look at a chart of UVXY, which owns like the short-term VIX futures, like it's tough out there.
yeah, absolutely. That's front month VIX futures have just been destroyed for the last few months, and those ETPs have got destroyed as well.
So do you have a view on, everyone is kind of complacent now because everyone's shorting volatility, the people who are long volatility, they're kind of retreating. So actually, I think volatility is going to go up, or do you think kind of this complacency can continue for a while?
No, I definitely do think the complacency can continue for a while. I do think that, when volatility, there's that whole sort of thing, like volatility can be bimodal, right? And when it clusters for a long period of time. And really that's kind of our view. But the view, I guess I'd say we have is more so that, yes, this may go on for a long period of time, but when it does have its move, the move will not be like 2022. It will be more similar to 2020.
Got it. Okay. And that's interesting. So how, I imagine now that the VIX is at 13 and implied volatility is lower, it's a lot cheaper to put on a hedge for a portfolio. Let's say a portfolio of exact 100% S&P 500. I mean, can you just walk us through how much cheaper is it to hedge that portfolio now that the VIX is at 13 versus 26? Like, is it half as cheap? Does it cost half as much because the VIX is at 13? And then I know you have the futures and it's always like upward sloping, but is this a really, are there cheap hedges out there, even if you think it will get even cheaper?
Yeah, so it depends really what you're hedging, right? Long volatility hedging is different from tail risk hedging, whereas like you look at the tails, right, and you price these from like a local vol standpoint. You could look at like this option versus, where that sort of floating strike 10 delta. I don't want to get too crazy, but like 10 delta VIX call was trading at 6 months ago, right? And check the vols from that standpoint. But I would say generally vols across the board are significantly cheaper, right? And yes, if you're thinking about something in terms of how much you had to pay for a, let's say, 10% 1 month out the money put on the S&P, it's been chopped in half, I would assume. I'd say that's a fair assumption over the course of that time period ending in 2022 compared to today.
Got it. And so VIX is a short-term 30-day implied volatility that has gone down a lot. What about the longer dated volatility? I'm just looking on the VIX futures. I think even though I know it never trades, but the December VIX future is something above 20. So even though current volatility or front month VIX future is 13, or I guess that's spot VIX, which doesn't trade, is 13. In December it's 21. So if you said, oh, I want to hedge my portfolio and buy a VIX future at in December, you'd actually, unless the VIX goes up 8 points by then, that you need that just to be flat. So is short dated volatility cheap relative to longer dated volatility?
Totally, 100%. Yeah, and that's really the view, right? Is that the market is saying that, well, there's a chance maybe of some sort of economic instability going forward, so maybe we may come into a recession, and they're pricing that sort of thing at a premium. But for right now, there is no tail event that's going to occur. And that's why you've seen one of the steepest fixed term structures, I'd say, in history, probably. I'm not too sure where that would rank on a percentile base, but I definitely know that it is truly up there. I mean, the curve is one of the steepest curves that we have seen in a really long period of time. So it's really that, you're seeing that sort of short dated thing where VIX is at 13, and then you're talking about in December or, even I think October, November, maybe trading around the 20s right today as well. And I think that something like that is we were talking about the ETPs, those could be detrimental for the ETPs, right? Because it's like that sort of roll yield, that sort of volatility risk premium that you have to pay is jacked, right? It's jacked up completely. So yeah, it's a weird view that the market has, where the market is pretty much saying that maybe a recession takes place, maybe more economic instability, and we'll price that vol at some sort of a significant premium. But today, we don't think that there's no sort of tail event that's going to occur within a short dated time frame.
Got it. So the market is the VIX market. It's kind of doing what when you turn on you see your Bloomberg and you see some strategists and they're saying, I'm bullish for now, but I actually think that in the future, we could have some headwinds like that. That's kind of
Yeah,
they're saying all clear for now, but they're in some distant future, and many months from now, they're just pricing it out that much. So does that pose some difficulties to kind of vanilla hedging strategies where I'm just going to buy a 1 year put on the S&P 500, you actually may be paying a lot more than if you just kept on buying the shorter term stuff, right?
totally. And I mean, I feel like we are the guys in the room that just pound the table on being strictly against these sort of dogmatic, vanilla, passive hedging strategies. Like you see that quite frequently, right? You'll have a person who will say, "Hey, I may have a $20 million, or maybe a family office that has like $200 million or something like that, right?" And then they say, or even a person with like $5 million, and they go and they look at some of these sort of solutions, tail risk solutions that they have, right? So they'll go to maybe like JP Morgan or Goldman Sachs or whatever platform they're on, and they're like, "Hey, you could be in this sort of program that buys a 3 month option and it will roll it for you every 2 days," or something like that. And what ends up happening is a lot of people gravitate to these sort of programs, and also more sophisticated people too, to the QIS programs. Like
What's
that's
that?
so some of these banks will package these sort of programs. It's quantitative investment solutions or strategies or something like that, right? So if you go to a large bank, they'll say, "Hey, we could do the hedging for you," right? But it's just some sort of dogmatic approach. And when you look at the results on something like this, people say, "Well, tail risk hedging sucks." Well, it's because really you're in these programs that are going to provide you this sort of terrible terrible product, right? Where it's consistent bleed, and then every now and again you get this pop, and you may just get back to even, and then they're like, well, I just broke even on my tail risk hedge, and that was that. And some managers would argue, well, you were able to compound the return, so you had a higher geometric return at the end. But like at the end of the day, you need some sort of alpha in the tail risk hedge. Tail risk hedging is a negative expected value bet to begin with, right? So having this sort of view that you could just bleed, and then when the crash happens, you just get back to even, or sometimes not even close back to even, it's just a poor application of it. So when you think of those sort of programs that are like, buy a 1 year S&P put consistently, it's just one of those things we cringe at, because it's just like, it's not the way how tail risk hedging should be done in general.
Yeah, I guess probably the ultimate example of a vanilla strategy is just buying UVXY, which you said that front month VIX future, right?
Totally, yeah.
Yeah, and so sorry. So it literally, because it I guess it does a reverse stock split. So now it's at $20. But if you bought it in October 7th, 2011, and you bought, it was that stock, the share is worth $20. Now it's worth less than $20. It just changed on my screen. Was worth $1.7 billion. So if you bought $1.7 billion worth of UVXY, it's now worth $20. So that's tail risk. And obviously you have that very negative correlation, which is very good, and that's why people do tail risk. But yeah, it's a negatively returning asset in the long term. And what you try and do is just limit that, and try and get some very, very cheap puts. But people who are buying a 1 year S&P 500 put are not doing that.
Yeah, totally. So it just the alpha has to come from somewhere, right? Like you cannot escape that sort of view. And really that's what we try to provide for investors, is this sort of flat return, but then in the case of a crash, this sort of explosive return, right? So you're not bleeding out consistently. That's where it becomes challenging, because if you go through, and this brings up the whole like ergodicity sort of component, which it's like, where do you land in time, right? So maybe if you invest in a poor tail risk strategy today, a crash happens tomorrow, and immediately you make a large return. And then you just bleed for years, right? Or here's another scenario where you start here, right, today, and there's not a tail event for 7 years, and you bleed. And then when the crash happens, you don't even make half of what you initially invested, right? And at the end of the day, when you look at that, and we ran, in our most recent investor letter, we ran this one, this chart that we have. I wish I could show you the chart on here, but there's some other stuff on there that I guess we can't share. But really what it shows is that, look, dogmatically buying 1 month S&P puts was worse for you over the last 15 years than just being unhedged completely. So you could have just said, forget the puts, I'm just going to be unhedged and return with a higher CAGR than using that sort of tail risk hedge. And the reason why is because of the bleed. So that's why our view is that, all right, if you could do something where you just are flat, use a lot of active trading to be flat, and then in the case of the crash, have a significant return, it's significantly better than these sort of systematic approaches where you're just buying the tails and losing until you finally get a pop.
And is that assuming that when there is a volatility event and those 1 year puts finally pay off, that the investor reinvests those proceeds at lower prices now that the S&P 500, because those, you expect most tail risk projects to have negatively returned. So that's even after they get the assist from the math.
Totally, exactly. And that's what that whole sort of compounding effect does, is because the geometric return at the end is higher, because now when you have this big explosive return in a crash, you're able to now take those returns and then reinvest it into the market, and you outperform significantly. But if done incorrectly, and 9 out of 10 times some of these managers will do this incorrectly, or these sort of programs will do this incorrectly, that's what you end up getting, right? And to me, I think that there's just a big disconnect from the industry, because what ends up happening is you have investors that are always seeking alpha. And 9 times out of 10, these sort of dogmatic tail risk approaches, or even some tail risk funds that we've seen apply these type of approaches. So what ends up happening is the investor goes in and they invest, and they're like, this is great, I'm going to have a tail risk hedge. And then either the strategy doesn't provide alpha, or the fund, the manager doesn't provide alpha. And then really what happens is the investor is really dissatisfied with the end result. But really it was an educational thing, right? It was this, you should have understood that something with such a heavy bleed, right, and the impact that it will have to your portfolio may be suboptimal over a time frame of 15 or 20 years or something like that. And that's kind of why I think, our approach, we did this whole presentation at the Global EQD conference, not this past one, but the year before, really discussing this sort of new, unique way to trade tail risk, where you could use a lot of active intraday prop trading to offset the bleed and then be long the tails so that at the end of the day, you're flat. But if in the case of a crash, you have this significant return. And I think for investors, that's just a much cleaner way than just buy a put and bleed, right? Because as what you said with UVXY, it's a perfect example. Hedging with front month VIX futures could be great, but if you just do it dogmatically, you're just, those are the results you're going to get. You're just going to lose money consistently. And then when it does, spike, that spike is not even going to bring you back to even.
And would a bucket of very out of the money puts on the S&P, very out of the money puts on the S&P, very out of the money calls on also those sort of these VIX products, and perhaps very out of the money puts on single stock names, but very short dated, 1 month, 2 month, and none of the 1 year's products, is that still tail risk, or is there something that's missing when you only have short dated volatility?
No, I think that it really depends on the path that you're trying to cover, right? There, like a lot of, hedging is path dependent to an extent, right? And if you're looking to protect against a tail event, most likely you're going to be looking to protect against 1 to maybe 6 month event, right? A S&P drawdown of 20% over the course of 3 years, that's not really a tail event, right? The tail event is a scenario where you may be invested in stocks or private alternatives and things like that, and you wake up and you realize something's going on, and in 2 weeks or a month your net worth has been decreased by 50%, right? That's a true tail event. It's not a scenario where you say, it's 3 years now down the line, right, and the market's just been slowly grinding. And you're like, oh, wow, now I lost 50% after a 3-4 year time horizon. So in terms of what the investor should be looking to protect against when they think about tail events, there's many other things that are better as a solution for a portfolio than a tail risk hedge to protect against a longer time frame drawdown. So I think short dated stuff is truly in the bucket of tail risk hedging.
If an investor were to sell these, December VIX futures that are at 20 or 21 right now, what is the risk in order to compensate for the bleed of being all these long, the short dated volatility products? What's kind of the risk there? What is the outcome where they will have a bad? Is it that just the term structure gets even more upward sloping?
Oh yeah, totally, Jack. You're playing down my line now. Now we're gonna go down to good stuff.
Let's do it.
Yeah, so the reason why I said, we can only discuss, like us from a strategy standpoint because, we can't talk about other managers or whatnot. But the reason why I said, like, we focus on a lot of short-term intraday prop strategies to offset the bleed is because those type of strategies hold zero correlation to the broad market, right? And they hold zero correlation to one another. And this becomes really important when you're constructing a portfolio, because especially a tail risk hedge, because previously, you've heard of a couple of firms that used to market themselves as carry neutral / long convexity, right? So they'll be, hey, we're going to make you money as the market goes up, and then when a crash happens, we're going to make you a ton. But inside of these sort of strategies, they carry different forms of risk, which could be belly risk, basis risk, timing risk, right? And what you
belly
saw,
risk. I've never heard of belly risk other than eating too much, but
no, I'll explain that one as well. But what you saw during March of 2020 was that a lot of these funds that were supposedly tail risk funds or tail risk strategies, they lost a ton of money. And people were saying, well, how in the world did you lose money when you were a tail risk fund? And volatility went through the roof. And that goes right into what you were talking about, right? Why wouldn't you just sell, December volatility to fund short dated volatility? Because if something happens, the front of the term structure is going to blow out and you're going to make way more money. We've heard this millions of times. And one thing about a tail event that you can guarantee is that it won't be similar to the previous tail event, right? And I actually knew people who were traders that applied these sort of, again, dogmatic sort of structures, but they say, hey, just sell the December and then buy the short dated, and then maybe in the next tail event, maybe it's something that prices the term structure completely wacky, and the December volatility that you're short blows out further than the front month stuff that you're long. And I know many people may say, well, that could never happen, but that's what a tail event is. And we actually saw this as well with a couple of other firms in March of 2020 when they were short credit vol to buy S&P vol, or sorry, they were short S&P vol to buy credit vol. And
Basis
what
risk.
exactly that, right? And they were saying, oh, we're Vega flat, and we are long tails, like da 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 da. And what ended up happening was, as the S&P was going crazy and S&P vol was going crazy, they were losing so much money. But the long credit vol that they were carrying did not catch up until the end. If you look at credit vol, it wasn't exploding during February. It started getting crazy during that time. Like I think the second or third week of March is when credit vol started to blow out. So they were losing so much money on the short S&P vol, and then finally the credit vol caught up. But these are the type of risks as a tail risk investor you don't want to take. You want to avoid that type of thing, because the last thing you want is during a crash, the manager comes and says, "Oh, I'm sorry, we only made 8%," or "Oh, I'm sorry, like this moved this way and we didn't think this would move that way and we ended up losing money," or something like that, right? Because at the end of the day, then it's pointless, right? So it's important as people who are thinking about tail risk investing to make sure they are invested in something that does not compromise the mandate of what they're trying to do. And when you're in these sort of structures that carry these type of basis risk, timing risk, belly risk, it can be good for a trade, for a speculative trade, totally, right? If you say, I want to sell December vol and buy, front month vol, yeah, totally. Maybe that works out and you get a spike and you make money. But as from a tail event where things could get really dislocated and crazy, that's just a risk that you probably don't want to take.
And if you remember in March 2020, I think the spot VIX went to 80 around there. I mean, I'm sure you know. But what did forward volatility, like what did December 2020 VIX future, what did that trade at during, let's say, I think the bottom was I'm showing off now. The bottom was March 23rd. I think the peak in VIX was actually March 18th. But was December 2020 priced at 90, like it was still upward sloping? Or when you have this sort of cascade liquidation and the VIX spikes to 80, is the term structure backwardated and the forward, December's priced at 50 or 40?
Yeah, no, totally. The term structure was absolutely backwardated. That they weren't pricing out that sort of forward vol at the same rate they were pricing out short dated. So it definitely wasn't that like December was at 90 or higher sloping or anything like that. But that's the thing, right? It's like for that scenario, that is absolutely true. But like the next tail event may be different, right? The whole term structure may move in unison. Like it may move up the exact same amount of vol points. And that sounds abnormal to some people, right? Like that sounds super abnormal to some people to say that, like, how in the world could that happen? But you had very weird things that took place, during that sort of time. I think there was one time period, Ben Eifert talks about this a lot, right? Where there was a time period during, I think in February, where implied variance was trading lower than S&P implied vol. So when you think of that, VIX is effectively variance, right? There's realized vol, there's implied vol, and then there's variance that trades at a higher rate. So variance is really like volatility squared. And when you think about that, when you have variance trading under implied volatility, that's sort of like, that doesn't make sense. Things are dislocated. How in the world could that happen? Well, during events like that, those are situations that present itself, right? So you don't want to put yourself in a situation when you're hedging against tail risk to be in something that compromises that.
And so you said you do these intraday prop strategies that are uncorrelated. Tell us a little bit about that. And then when you say uncorrelated, is it the basket of trades is uncorrelated? You do 200 trades, some are positively correlated, some are negatively correlated, and they average out to a correlation of 0.02, negative 0.03, and it's like roughly zero? Or is every single trade literally like correlation of zero?
No, I would say like with a couple of the sleeves, they do have like a little bit of correlation. It's slight. It's really slight. But the flavor of these type of things, right? The book is or the way how we think about this, for investors is really, okay, if you have an investment or you have one side that is long tails effectively, And then in the other bucket that's running these sort of intraday strategies, you're looking to capture sort of like a behavioral dynamic. So maybe there are very aggressive buyers and sellers of a specific common stock or a specific derivative. If we can go in and we could take advantage of that on a very shorter time frame, right? Within it's like whether it's like 5 minutes to an hour and a half or something like that, be very fast in and out of these trades. The returns that you make from there could fund the tails. And what this looks like for the investor at the end of the day is that they're flat on all of those by the end of the day while still being long the tails. So if a tail event happens, they are always in that sort of tail protection, but the alpha that's being generated does not deteriorate the sort of, or I'm sorry, the tails that's being carried is offset by the alpha that's being generated. So it's really this sort of balancing act there.
Sorry to interrupt. Wanted to let you know about Blockworks' upcoming crypto event, Permissionless 2. This ultimate DeFi gathering will be taking place in Austin on the 11th to the 13th of September 2023. It will feature the very best discussions on ZK tech, rollups, account abstraction, MEV, and much, much more. All the big hitters in crypto are going to be there, so if you're into crypto, you need to be there too. To get a 20% discount to a full 3-day pass to Permissionless 2, click the link in the description and use code GUIDANCE20. That's GUIDANCE20. Thanks, and let's get back to the episode. Because now let's talk about 0 day to expiration options. How new are these things? Just how much have they grown, and how big of an impact do you think they have on the overall market?
Yeah, this is a super hot topic, and we wrote a paper about it that got a good amount of traction that we're quite happy about, because it seems like people had a lot of misconceptions around the 0 DT options. Everybody's trading these sort of 0 DT options today, right? I would say that it's become a big part of the derivatives ecosystem. You know, you're seeing market makers, you're seeing vol shops, you're seeing larger insurance plans, you're seeing retail. There's tons of people that's trading them. I think the important thing to understand about that is that, you know, the narrative that was driven by a lot of the media was that this is retail driven, whereas that's not true. It was really more so larger institutions are using this in different fashions. And in the paper, we talk about how these institutions are using this in different manners. I would say the other misconception was that everybody is YOLOing these 0 DT options. And when you looked at the data, it said something completely different. Everybody's actually selling these 0 DT options for some sort of overlay or some sort of a yield program.
So who's buying them?
Yeah, well, of course, right. On the other side, there has to be a buyer of these type of options. I would say market makers end up inventorying that type of stuff, you know, majority of the time, and it works out, right? Because at the end of the day, if you're a market maker, you're utilizing these sort of 0 DT stuff to help hedge your gamma risk much more effectively than you did previously, right? So that's kind of the fit that we end up seeing, is that, all right, market makers are using this to hedge their own exposure in a cleaner manner, whereas the end user is actually the one that's ending up selling them, right? And I think one of the largest amount of sell flow that we identified was actually coming from the RIA community, right? So you may have like an RIA that's out in the Midwest that may say, hey, I want to generate, you know, another 4% for my client this year. How do I do that? Well, let me sell 0 DT S&P options that are 2% out the money, you know, on the calls or on the puts or whatever. And let me do that consistently. That's really been the flavor of where we've identified a chunk of the flow.
Got it. So, you know, the large market makers, the biggest one, I think it's Citadel. So I'll just name that. For example, they would, you know, they're on the other side of so many different options flows, and they have all sorts of, you know, Greek risk, Delta, Gamma, Vega, and, you know, many others that, you know, I've no idea what they actually are. So you can hedge Delta pretty easily just by buying or selling the underlying stock. But to hedge, you know, Gamma, you can only hedge like Gamma with a convex instrument. You can't really hedge it with a stock. So you have to be long or short an option against that. And you have an explosion in these 0 day to expiration options. It's become much more easy, much more liquid for market makers to do that, as you said, to hedge their Gamma. On the other side, you have the RAs who are trying to get their clients and get some yield. Who's winning? I know every one trade Citadel wins, one trade the Midwest RA wins, but in aggregate, like who's I mean, the smart money is Citadel, but and the market makers, but who is kind of benefiting? Which trade has a positive expected value on average?
Well, so in this environment, selling the options have definitely proved well, right? And in the paper, you guys could go on ambrusgroup.com and click on the research side, and you'll see the paper because we show a
We'll
backtest.
include a link in the description. Yeah.
Yeah, totally. So we show like what the backtest results look like if you were to just follow these sort of dogmatic approaches, and it's worked, right? If you just close your eyes and just sold these sort of out the money zero DT options, you've ended up making money. I would say that doesn't necessarily mean the market makers are losing money, right? That's the two don't go hand in hand because, as I was saying, market makers are using this as a cleaner way, and vol shops as well are using this as a cleaner way to hedge their sort of intraday gamma risk. Whereas you may need, previously maybe you needed to rely on a 7-day option or something like that. Now you're saying, well, I don't need to pay that price. I could pay, a 1/8 of the price that I would generally pay, and I'd be able to hedge that sort of intraday exposure significantly better. So hand in hand, it's definitely the people that are selling options in this environment they're definitely winning. I would say that there is something else that's really interesting that's going on about this sort of thing. It's the large brokers and their ability to assess intraday margin is really, really important, right? And what I mean by this is you can effectively come out and sell tons of zero DT options, right? And the way how intraday margining works with some of the larger primes, and it's almost insane that it's so primitive. They don't have necessarily good risk systems in play to identify, hey, by the way, you could blow up doing this, right? And this I'm not talking about just retail. I'm talking about larger hedge funds that are doing this, like the Bill Wangs of the world. There are people that are doing this, and some of the larger primes still don't have systems that are in play to monitor some of the intraday stuff as good as they would like.
And Kris, let me just explain for the audience. So, margin is borrowing. So, if you're long like an oil contract, it's all on margin. How much money you're allowed to borrow, and if you're short a 2-year note, it's not that volatile. Like it's at 100, and if the Fed funds, if the Fed goes crazy, it might go to 95. It's not going to zero. Whereas like the price of oil can go zero, it can go below zero. And so it's just based, I guess, how much margin they give you, can range from less than 100% margin to, how much margin do they give you on intraday options? What's the sort of requirement of how much capital they have to put down?
Yeah, so it differs per bank, right? And it differs per client, right? So if you're some small shop with just a couple of people, the margin that you'll be able to get is significantly different than a $5 billion hedge fund or something like that. And that could be problematic as well, right? Because maybe the $5 billion hedge fund is the one that are taking that sort of implied leverage if they're selling these sort of out the money puts or out the money S&P calls. And you could see how this opens up this scenario to slide risk, right? What happens if you say the market's going to go down 10% in one day? How does this wipe out other people and cause this sort of reflexive intraday sort of hedging that could cause a crash, right? And I hate to be like the whole perma bear sort of thing because we're really not. At our firm, we're more trading focused as opposed to perma bear betting and hoping the market is going to crash. But really, when you think of this from a systemic standpoint, you can't help but look at the sheer amount of notional risk and the gamma risk that's being taken across the board from just this implementation of it and think that, all right, there's never going to be a scenario that's going to present itself that can lead to a crash because systemically it has the power to do that. I mean, we talk about the whole JP Morgan, collar roll and how that impacts the market and all these sorts of things. Zero DT is significantly more than that now. It's significantly more than that.
Yeah. So Kris, if I could kind of push you on some numbers. So I'm going to make up numbers, but then I want you to supply some real numbers. So if you're short a 1 month put option on the S&P 500, so you have to hold a certain amount of capital against it. But when these 1-day options, how much capital do banks and large institutional players, hedge funds such as yourself and other larger have to hold against them? I've heard that it is ridiculously low, like the lowest possible, as in you don't have to put any margin at all. And so is that true?
Yeah, totally. So that's the thing, right? It's that some of these banks and their I would say their procedures are still adapting to this, because this is a new sort of thing that's been implemented, and I don't think that even like SIBO or the exchanges, or even the OCC, or nobody thought that it would become this popular, right? Like it has well exceeded expectations. So the banks are still starting to deal with, okay, how much margin requirement do we need? Does this even need a margin requirement? Are we going to lose clients because maybe some other sort of bank is going to say, hey, you don't need to put up that much margin to trade these sort of things, right? And right now it's sort of this very gray area across the board. But you're right, it's super low, right? And that's the problem to start with, is that you do not have a hard barometer to stop a sort of cascading effect from occurring if a couple of hedge funds are massively short these sort of zero DTE stuff, right? I mean, think about it, right? If you put up, I just do. You wanted to go do some numbers, right?
Yeah.
Let's say you say, okay, I want to sell these 10 delta S&P puts, and we do see that, right? You see those sort of 10 delta S&P puts being sold intraday, right? So 10 delta, 0 DTE S&P puts. Let's say you put uh, let's say you put 5% of your portfolio to collect premium, which is an insane amount of number. Or actually, maybe let's go 2.5,
That's
right?
still large.
That's significantly large, right?
Yeah.
Collecting that type of premium. Because when you think of the way how an option moves, I mean, options could go 20x. Zero DTE stuff can go 100 times. They could go 400 times,
Yeah, and you're
right?
short. So the maximum you can lose is not 2.5%. It's
Exactly.
it's 2.5% times how many times
Times
the option
100.
moves.
Times times 100, right? If
Yeah.
it gets to that. And some people would say, well, the firms will hedge that, they'll cover off the exposure, but this brings in the whole point of jump risk, right? It's like, okay, what about if you have the market just out of nowhere, slides down,
And
and
that,
then
Chris, is the market does not go from 40 to 38. It doesn't have to go first to 39 and 99 cents, 39 and 98 cents. It's discontinuous. It can just move.
totally, there is
Whereas
jump risk.
statistical models assume that it has to go 39.99 first, right?
Exactly, totally. And real markets don't work that way. In favor of the people who do believe that, though, what I would say is that if there's one product in the whole world that's the most liquid, it would be the S&P 500, right? So, like, you can argue that the S&P 500 would be mega liquid, especially with all the market makers and stuff like that. But that still doesn't take off the situation that lays on the platter, where you can still have the market skipping through certain strikes and getting to certain prices based on some sort of news, right? I mean, imagine if today, I mean, God forbid, right? God forbid there's some sort of geopolitical tension and there's some sort of nuclear bomb that gets set off. You think the S&P would not react, or some of these high frequency traders or market makers would not jump over the price? You think they're going to say, oh, the S&P is going to go from 4,400 to then 4,390 or whatever, right? Or then to, like 4,100. It doesn't work that way, right? It will skip on you absolutely intraday and definitely overnight. So I think those are the hazards that kind of presents itself with these sort of zero DT stuff, because you have to think about the sheer amount of exposure that's being inventoried with some of these firms that have actually been able to get away with it over the last year and some change, because we were talking about which trades have been making money. Short vol, zero short dated stuff has totally been making money.
Right. And so 0 days to expiration means it's, the option is going to expire that day. So, US stock market opens at 9:30 a.m. Eastern time, closes at 4 p.m. Are 0 day to expiration options, are they all options that, used to be 2 days old, but now they became one, or are they actually written at like 9:30 in the morning and then expire that day? So they're literally like, a dragonfly that lives for one day.
Yeah, pretty much. That's. I mean, you've had zero DT options for I guess technically since forever, right? Because at some point there will be an option that expires on that day. But really, what ended up happening was some of the exchanges started seeing the appetite for these sort of products, and then I may be getting this wrong, but they started listing the Monday expirations. Instead you had Fridays, and then I think they went to Wednesdays, and then they started doing Tuesday, Thursdays. And then once the Tuesday, Thursdays, you realize, well, okay, so there's options for literally every single day of the week now. And, I think you're going to start seeing that with single stocks as well. I think that's the next step up, is some of the exchanges will try to push some of the single stocks. And in the tech names and the names that are high flyers, you see a more active option chain, right? Like I think Tesla, you have Monday, sometimes you may have another one. So Monday, Fridays, whereas maybe some smaller cap illiquid name, you may only have a monthly or something like that. So the exchanges are definitely trying to feed into the appetite for these sort of things.
Right. And what do you see in the market that's something I or our viewers here, most of our viewers here, could actually observe that do you think could be explained even partially by zero day to expiration? So it's not in the vol space, but what ripple effects does it have in easily observable markets? Are there any phenomena that you can easily, that are kind of vanilla instruments in the S&P 500, how it moves or something that you could attribute to the proliferation of 0 day to expiration options?
Yeah, totally. So we write about a couple of things in terms of like how the gamma profile has changed, how the Vega profile has slightly changed. We write about how the volume transition has changed. I think the most important, or I would say the most qualitative thing that may be just most relevant for just a regular investor is if you just take some time and you just sit down and then maybe some people don't have all day to look at the S&P, right? Because it could be very boring. But if you look at the price action in the S&P, you'll see intraday, especially on OPEX weeks, there are things that start to move in a very abnormal manner, right? So on no news, you may just see the market just do this, right? It's looking like it's going to tank. And then out of nowhere on no news, it just turns around and goes right back up. And people are like, how did the market was down, 1%? How in the last 15 minutes it turned to be flat? And in the last 30 minutes, it closed up 1%. For vice versa, the market was up, 1.5% and just ended up closing down, 1% or something like that. On no news, no catalyst, nothing at all. The price action itself in the broad market is showing you that on a smaller time frame, this type of volatility is being enhanced, and we believe that it's being enhanced because of the zero DT stuff and the hedging that comes from there.
And so it would be people who own puts hedged it by buying stocks, I guess, maybe, or people who were short puts hedge it by shorting stocks, and then as the puts expired, sort of out of the money, or as the S&P 500 went up, they had to buy more, so it's reflexive.
Correct. That's a reflexive. Yep.
Got it. And I mean, just to read the conclusion from your paper at Ambrus about the paper. You talked about how the reflexive flow can accelerate extreme price action and that the size of the gamma risk from these contracts can be hazardous. I mean, how seriously are you entertaining the risk? I mean, of just how hazardous it could be. I mean, what does hazardous mean? Is it just something that a few people in the vol space will notice, or it'll be something that could have some significant effects on the broad market?
No, totally on the broad market. All right. And I think that this could lead to a more reflexive 1 day move on the S&P, or it could cycle into a 2 day move in the S&P, right? When you talk about, okay, can the market go down 7% in 1 day on no news? A lot of people do not believe that, right? A lot of people will not subscribe to that. They'll say, oh, the market makers are super liquid. They'll be able to price that back in. But like when you look at the sheer notional that's traded, and when you run some sort of a shocks and slides scenario on these sort of things, and you look at some sort of a Monte Carlo sim where you just think forward forecasting in the next 20 years, you mean to say that no event will occur on that time frame with that amount of notional being traded that can drop the market? Like out of all the different paths that could take place, no event will. I mean, obviously we're bound to run into it. It's and I hate to sound like this, but it's one of those things that it's inevitable. We will eventually see a day where that sort of thing comes up, on the roulette wheel, that it's bound to happen when you have that type of sheer amount of notional exposure that's being traded. And look, it's one of those things too where I think back, the XIV thing, right? The
Mm-hmm.
volume thing. I think back,
Yeah, so that was in early 2018, and that was an ETF that was short volatility, right?
right, February 2018. How many people in the volatility space knew that was occurring? At a conference, you had Chris Cole and Michael Green both stand up and went toe to toe, right, and got in an arguing sort of match with one of the creators of the product itself, saying, "Look, this product is hazardous. It's going to go to zero." Everybody, like people in the vol space knew. There were people. I mean, Tracy Alloway, right, was one of the people that put out that tweet saying, "Hey, this is probably going to be bad for the VIX CTPs if volatility were to spike." Right, like everybody knew that this was an inevitable thing, but people kind of just took it and was like, yeah, whatever, right? Yeah, whatever. There is no genius sort of take here to say that zero DTE is definitely going to impact the market. Everybody has this sort of view that says like, oh no, all these people are perma bears, or they're just trying to get engagement around zero DTE. The reality is that you have this brand new product where regulators don't know how to regulate it. You have the brokerages that don't know how to provide some sort of margin requirement around it. People are very engaged around it. They're trading it. Trading an environment where volatility is very low. How can you not expect something to come from those type of dynamics when they're bucketed together, right? So that's really our view, is that we have no crystal ball to say that, all right, is this going to happen tomorrow or the next day? But like, if volatility starts to pick up, these products definitely have the strength to move the market around on a regular day. So it would be in our opinion quite foolish to believe that it would have no effect on the market on a day where there is a true catalyst and volatility is moving.
And you think this could be a huge one-day crash, a 6%, 7% move?
I know JP Morgan came out and said a down 20% move. It could lead to some sort of a down.
In a day,
Yeah,
in a one day. What was Black Friday like?
yeah, it was about 20%.
Wow, in one day.
A little more. I think like 22 or something like that. I'm
Wow.
probably more than that. But yeah, I think Kalanovic came out and said that it would be a down 20% day. I mean, maybe. The models that we run, when we kind of model this out, we saw more like a 7.5% impact. But the models, what do them? Who knows when that moment happens, right? Maybe it's down 30% or something like that. I don't know. I have no clue, but I just know that it can certainly escalate the price action of the S&P.
And is the S&P 500, can that move? Don't they have a circuit breaker for 5% or something?
Yeah, so there's a couple of circuit breakers. Down. I believe the final circuit breaker is down 15%, where they halt trading. A lot of people talk about, oh, halts are good, they minimize volatility. Like, I don't believe that. I think halts escalate volatility. If you're a fund manager and I tell you that the entire broad market is halted, what's the first thing you're going to think about doing? You're not going to sit there and say, oh yeah, I'm going to hold these now because it's going to turn around. You're going to say, oh my God, like our positions are down. Like we probably need liquidity, because if this thing continues to halt, like we're not going to be able to get out. So that's just my view, is that I don't think halts, and you see this in small cap stocks as well. If you look at some of the price action in small cap stocks, halts go on every day. If the Nasdaq puts this stuff out every single day, you have like a halt list, right? There's different types of halts, volatility halts, and things like that. But behaviorally, I'm not a subscriber that a volatility halt on the broad market is going to calm volatility.
Yeah, and even if there's no listed price, it's only down 5%. The sort of over the counter trading could imply there will be a price, and the options will price it in a forward market, even if the market isn't listed in a kind of a shadow bid. So do you expect this to be a 1 day, 2 day, 3 day event, and then calm will resume to the market, in which case it would be good to short volatility on like the second or third day? Or do you think this actually could cause something systemic, that, oh, it's not just a flash in the pan, this is something serious?
I don't know. I'm not. I'm not too sure. Right. I don't want to give any sort of answer with conviction, because I think it's a very gray area, and I think that the only thing that we feel strong conviction on is that you now have this this huge elephant that's in the room, and people are saying that the elephant won't break through the door. After a certain amount of time, the elephant's going to break through the door, right? Because it physically can break through the door. The ramifications that occur after that, I'm not too sure. I'm not too sure if regulators will step in. I mean, you saw with the VIX ETPs, right? The regulators were very hesitant to list more volatility ETPs after the XIV thing, right? So there were a couple of more of the ETPs that you had firms that were trying to bring to market, like XIV, VIX, and it took a long time period, right? And the reason why is because regulators were saying, how do I know that these sort of ETPs will not cause a systemic risk? Because it almost did during Volmageddon, right? Volmageddon was very well contained to an extent because volatility went up, the S&P went down about like 4%, and then like within a week, everything was kind of cleared out. But think about the amount of notional or the amount of exposure that's traded then compared to the zero DTE now. It's significantly different. So yeah, I don't know if something, you have a crash event that occurs and then regulators look to be more stringent on these sort of policies. Regulators are asking about these sort of things though, right? They're definitely not asleep at the wheel. I think people think that, they don't even know that zero DT is doing this. They've definitely been inquiring. And I think that they're just trying to lay out a policy that will be feasible for market participants and, well in line to make sure that the banks will be, I'd say, hedged up as well.
Right. But regulators inquiring about it and being aware of it is different from them doing something about it and having a policy, right? So is it fair to say that there are many aspects of finance and financial trading that are well regulated, rigorously regulated, but zero day to expiry options is not one of them? Is that fair to say?
Yeah, I would say for right now, just of the sheer nature of the infancy of it and the timing of it, there are no policies around it, right? And again, you're still trying to get banks that are factoring in the margin requirements and things like that. So there are no real regulations around this. Maybe there won't be, right, until after a crash, or maybe there will be in 4 months or something like that. But right now, it's a new space in the market that is garnering a lot of attention, but there has been no action to move on it as of yet.
Got it. And just to be clear, so I've heard that the largest institutional players are allowed to sell these with effectively infinite leverage. Is that true?
I don't know if I could say if that's true or not. I don't know. Maybe you may know something that I don't know.
If you don't know, I don't know.
But I do know that there are definitely very large institutions that are aggressively selling these sort of things. I think Jason Buck and the team over there went to the Global EQD conference, and they may have had some sort of commentary as well. But like, we have a couple of friends that are in the business. You talk to people, you get to know people, you go to conferences and panels and things like that. And some of these larger participants are open that this is what they're doing, and they see it as a form of yield. And I think there's a lot more of that, and people are more tight to the chest, don't want to say that, but the data affirms that people are trading these in large size and they are selling them
with lots of leverage.
I couldn't speak on the leverage, but I think so. Yeah, I think that's what we're saying. Yeah.
Hey there. Sorry to interrupt. A lot of Forward Guidance listeners are not into crypto. If that's you, please skip ahead, get back to the interview. Some Forward Guidance listeners are into crypto. Some own crypto. A smaller percentage owning lots of crypto, and a much smaller percentage work at crypto hedge funds. If you're in those latter two categories, Blockworks Research might be a good fit for you. Blockworks Research is a research and data platform that analyzes governance, tokenomics, and models of interesting crypto projects, including new protocols. There's a lot of edge that can be gained from reading these reports. You can check out a sample report at www.blockworksresearch.com/research and hit the free report toggle. If that is of interest, full subscriptions can be purchased at www.blockworksresearch.com/sign-up. You can also get 10% off using the discount code guidance10. Thanks, and let's get back to the interview. I got it. Well, Kris, now let's move to a topic that's maybe a little bit out of your world, which is interest rate hedging and the banks. Do you have any thoughts on sort of the banks hedging of their interest rates?
Look, there was a couple of things that were really interesting that happened throughout the last year and a half, right? The first thing was the impact that the gilt market had uh, across the pond, right? With some of the larger pension plans over there in Britain. Um, that's a real thing, right? That's a real thing where you saw the ramifications as to what it could be. Thankfully, that was contained. But then you saw another form of that during the whole SVB thing, right? Where the interest rate exposure that these domestic banks had were, it just wasn't able to handle that type of volatility. I personally think, and this isn't my space, we trade equity vol, but I personally think there's more of that's kind of under the cover. It would be foolish to think that there isn't more of that, right? The majority of the industry is set up that way. I know banks have XVA desks, right? And XVA desks are similar to like a tail risk desk, right? XVA desk is pretty much designed to hedge on off the sort of bank explosion sort of thing. And I would say in this type of environment, that's one of the factors that they continue to look at and try to hedge off as well, right? Because banks are so interest rate sensitive. And when you've had years and years and years of this sort of policy where volatility has been pinned, when you start getting the unpinning, right? When you start getting the unpinning, you're bound to have things that are breaking. And this was something that we were talking about last year, was that we don't think that the Fed raising interest rates is going to necessarily crash the market, but it's the implications that can come from the interest rate hikes that can lead to some sort of systemic risk, which is an example, maybe like the SVB thing, or whatever it is to kind of come down the line. But I would say that continues to be a situation that um, I would say banks are slowly evolving into, or slowly getting that risk off. The good thing is that I think the Fed, and some people may chastise me for this, but I think the Fed has done a good job in tailoring expectations to the market. So it hasn't been a situation where you just wake up and it's a 50 basis point hike out of nowhere. That's dangerous in my opinion,
Mm-hmm.
right? That's what causes those type of events, when the banks are not in line with what the Fed is going to do. That could create that type of thing. But when the Feds give you a dot plot and they relatively stick to the dot plot, it gives the banks guidance and times to hedge out these positions and ease through it.
Yeah, for guidance. There we go. I think what's really tough with the banks, particularly the regional banks, is that so much of banks hedging and whether they think they're long rates or short rates, if they make money, if interest rates go up or down, is based on how many loans they can make at higher yields and how much their deposit costs go up, and how fast deposits leave the banks based on that spread. And all these are assumptions. So with a few pen strokes, you could say, oh, actually, we're hedged, or actually, we're not hedged. A final question for you, Kris, is how do you think about tail risk managers such as yourself? How do you report your results to current clients, or present your returns to potential new clients? Because if I am trying to beat the S&P 500, S&P's up 9%, I'm up 11% with a certain Sharpe ratio. Oh, wow, I beat the market. But as a tail risk manager, you're really trying to get those positive returns when everything else is crashing, that negative correlation, so that even if your fund, during 2020, even if a tail risk fund was, quote, down 10% in aggregate in 2020, if it was up, a tremendous amount during March of 2020, that provided a value. So, I mean, do you report do you do what a regular manager says and just says, oh, we're down 10%, or is there a different reporting mechanism? Could you tell us a little bit about that? And then maybe you could also share your thoughts on the alternative reporting mechanisms that other tail risk funds use.
Yeah, I think that's all smoke and mirrors. I think that's a terrible way because it's misleading to investors. We look at it in terms of, if you give us $1, how much did you make or lose on that dollar? Not that dollar is based on an overall part of your portfolio or something like that. I think that can be very misleading. And a lot of people that are in the tail risk space, they tend to try to do that, right? You saw, a couple of the larger managers say like, hey, you know, let's say you allocate $1 million to them, and after 3 years, they've lost it all, right? And they'll say, well, no, that $1 million is only one piece of your portfolio, right? 1% of your portfolio. So you only lost 1%. And the industry has kind of gravitated over towards that. But we don't, that's why we don't really bucket ourselves with that sort of way of tail risk, because it's like, we don't believe in it. We don't believe in that sort of approach. We believe in, okay, if you give us $1, our job is to try to trade during markets going up or markets being flat, to make sure that your return is, at the end of the day, at the end of 2 years, 3 years, $1. If a crash happens, hopefully that dollar turns to $3, $4, $5. That's really the goal. It's not sort of bleed, 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 and then we make the reporting off of what the expected performance was, or sorry, what the portfolio holding was. I think that that's just not really a good way or an honest way to present performance numbers. The other thing I would say is, we have an SMA, an RIA business, which handles SMAs. So you may have
Separately
times
managed accounts, yeah.
Yes, right. You may have times where investors come to us and they say, hey, can you customize some sort of hedging solution for us? We'll present some sort of custom hedging solution for them.
Is that also known as an overlay, or?
Yeah, those could be sort of overlays, right?
Yeah.
But generally, 9 times out of 10, we'll tell them, unless it's something that's very exclusive. Like, you may have somebody that may say, hey, I'm trying to hedge off my Tesla stock risk, right? Whereas you have to make sure you hedge that directly. But on the other side, we have the hedge fund arm, which I can't really speak to the hedge fund because it's all compliance and stuff like that. But if you guys want to see the performance numbers, you could go on websites like HFM. You could see our performance numbers on there. And we think, the numbers will play in line exactly what we're saying on this thing, where we don't really believe in that sort of continued bleed approach, or reporting it in that sort of manner where you say, hey, you've given me $1 million, but that's 1% of your overall portfolio. And you've lost all of it, but I'm only going to say you lost 1%. That's just a very poor way of doing it, in my opinion.
Got it. So that's a methodology when a tail risk fund that has a lot of bleed, they may report it in a way that underreports their true losses, as you see it. But what about over-reporting the true gains? I mean, to the extent that there are tail risk funds that say, oh, we were up 1,000% or 2,000% or 3,000%. And, a few come to mind, perhaps. One in particular. I mean, what methodology are they using? Are they saying, oh, during March 2020, we made so much money that if you had invested it back in the S&P 500, you would have been up 3,000%? I mean, I literally don't even understand it.
Yeah. So a good friend of mine who's another tail risk manager is Boaz Weinstein. Shout out to Boaz Weinstein and the guys over at Saba. Those guys are really good guys. I think they do a fantastic job too. We had dinner and we spoke about this directly, right? And I want to give the listeners an understanding when they see things like, oh, this hedge fund made 4,000% or 5,000%. That's not the case, right? The most convex of convex products will not return that. Right. And here's how this effectively works. Let's say you give a tail risk manager $1 million. Right. You give a tail risk manager $1 million. And pretty much what ends up happening is, from the time that you have that sort of $1 million, they start bleeding money. Right. They start bleeding. Now, in that sort of allocation itself, they will have options that they are carrying. Right. And they may end up like, so let's say, for example, I buy let's say I use a percentage of the allocation that you gave me, and I bought a S&P put for 5 cents. And the S&P put for 5 cents has now went to, let's say, $1. You're not going to say the return, right, on that allocation was 2,000%, because guess what? You've bled. And then all you did was just get back here, right? Is the return 2,000% on the investment? Absolutely not, right? You did not return 2,000%. You have lost 90 something percent. You know what it's similar to? Like, it's like UVXY.
Yeah, yeah, yeah.
It's exactly like UVXY, right? Where if you think about it, if somebody says, if UVXY is at $2 and it goes to $10, you're gonna be like, oh my God, it's 5x. You know, you return 5 times the return. Well, guess what? Over the course of 1 year, you're still down 90 something percent, right? It's important for investors to understand that when they're thinking about a tail risk allocation with some of these type of passive products and these type of passive institutions, to understand the convexity versus the carry that they're going to have. And there's a very easy way. You just look at the carry, what's the anticipated carry and what's the anticipated payout profile. If you shock the S&P down 20% and vols are up like 30, 40 vol points. So I think it's really a learning thing, but some of these type of managers will have different approaches where they, you know, they may use marketing and things like that, and they may get headlines out, but really, you know, even the most convex of convex products will not return 4,000% in a market crash. It's very responsibly, I would say.
Got it. Yeah, that makes sense. And that goes back to the bank hedging thing. Like, if you were a bank and you adequately hedged for a 500 basis point increase in a year, you hedge too much. You know what I mean? Like, if you're always preparing for March 2020, you're just going to be bleeding a ton.
Right. That's why at the end of the day, you have to get alpha from somewhere, right? And this is the thing that we preach. If you have no alpha, right, an investor is in a negative expected value sort of thing, like tail risk hedging is negative expected value, and you have no alpha, it's a double whammy, right? Now you're losing both ways because it's just going to look just like that. But I think the people that do their due diligence and they kind of go through the rounds, they may see that there are better sort of options for tail risk sort of strategies than the ones that they are used to seeing. And the more the industry gravitates over towards those sort of different approaches, I think it overall, you know, will be better, and we'll move away from this sort of way of thinking about these things where it's ridiculous that tail risk managers even report that sort of thing, where they say, oh no, my performance numbers is based on the overall allocation amount. It's just like smoke and mirrors, right? No.
Yeah.
How much money did you give me? How much money did I return you? Point blank, period, right?
Well, Kris, my podcast gets 30 billion downloads an episode. You know that, right? I'm just kidding. All right. Well, Kris, thank you so much for coming on. We'll leave it there. People can find you on Twitter, of course, where you're quite active at KSIDIII, 3 I's. And of course, your fund is at ambrusgroup.com. Thanks so much for coming on, sharing your insights about volatility. And thanks everyone for watching.
Thanks so much, guys.
Forward Guidance, the program you just enjoyed, hopefully, can be viewed on YouTube at Blockworks Macro or heard as a podcast on Apple Podcast and Spotify. Episodes are typically released on Apple and Spotify a few hours before they air on YouTube. Please leave a review on Apple Podcast if you feel so inclined. Also, you can get 10% off to Permissionless 2023 and Blockworks Research using code GUIDANCE10. Thanks again, and be well.